Hello and welcome to another session where we are going to discuss one of the recent tax development, which has been a matter of debate and discussion a lot around the tax circles. Now we thought instead of going through so much of literature, why not simplify the entire concept in under 5 minutes? And that's where this video has come into picture. And this topic is nothing else but around the increase in the withholding tax rate in respect of payments for royalty and fee for technical services. What are the implications of such a change, both in terms of the tax outgo that has to be there for the non-resident, as well as the document that the non-resident has to provide, and finally, whether they are filing the return of income in India or not. All these three aspects are something that we're going to cover as a part of this short video. So a non-resident typically, when he gets a royalty or fee for technical services from India, has a withholding tax rate. Now this tax rate is 10% under the Income Tax Act, and depending on how the TDS is deducted, the non-resident has to file an ITR, or maybe he's exempted from filing an ITR. However, where he claims the benefit of the tax treaty, he has to provide the PAN number, Form 10F, and a tax residency certificate. Now, this withholding tax rate under the Income Tax Act until 31st of March was 10%. But under the new budget provisions, this tax rate of 10% has now been increased to 20%. Under various treaties that India has entered into, the tax rate might be 10 or 15%. Until now, what was happening was that because the rate under the Income Tax Act was lower than the one under the tax treaties, the taxpayer used to opt for the treaty provision. Now, this rate was not 10% actually. There was surcharge and cess overall above this tax rate. The taxpayer used to opt for this rate, and by opting for this, they were not required to file an ITR. There's a specific provision that if the tax has been deducted as per the Income Tax Act, there's no requirement to a non-resident who's just deriving such royalty or fee for technical services to file ITR in India. Now what has happened is that the rate under the Income Tax Act is increased to 20%, and of course the surcharge and cess over and above this. So what this does is that for a non-resident, opting for the treaty becomes more advantageous compared to the opting of the Income Tax Act. Now what this does is that if he opts for the treaty provision, the tax has not been deducted as per the Act. If the tax has not been deducted as per the Act, now they have to file an income tax return. Not only this, if the non-resident wants to claim the benefit of the tax treaty for 10 or 15%, they have to provide a Form 10F and a tax residency certificate from their home country. Obtaining a Form 10F requires opening an online account with the Government of India, for which a non-resident may be required to obtain PAN. Unless there's a new mechanism that comes in whereby the PAN requirements are not required. The moment you get a PAN, you get a reminder to file tax return every year, because the tax authorities would want to ascertain whether the benefit of the treaty has been claimed properly or not. In other words, once you have PAN, Form 10F and TRC, you are required to submit them. But if you do not submit them, then you cannot claim the benefit of this lower tax rate. Insofar as ITR is concerned, it has to be submitted if you're opting for the benefit of the tax treaty. But if you do not opt for the treaty benefit and get the taxes deducted as per the provisions of the Income Tax Act, and that is the only income for you, then you are not required to submit an income tax return. I hope this concept clarifies. If there are any follow-up questions, please feel free to drop them in the comment section. You can subscribe to our courses on courses.sortingtax.com and subscribe to our YouTube channel, as well as other aspects through which you can stay regularly updated on all the videos that we are creating.